U.S. home price growth reaches its lowest point in over a year this August, according to CoreLogic. We're going to be talking a lot more fundamentals. And are we at this perfect Goldilocks inflection point where the economy is slowing down a little bit, but there are a lot of positive fundamentals to look forward to as we get into 2025 and onward? A piece from Marcus and Millichap today on the Great Report: home buying is out of reach for many households despite lower debt costs. And then another piece from Goldman Sachs: U.S. house prices are forecast to rise more than 4% next year in 2025. And then a piece from Colliers looking at national migration trends. And then the round off this episode looking at a piece from Moody's Analytics, their third quarter 2024 preliminary commercial real estate trends, looking at some positive macroeconomic developments, again trying to paint a picture of what the next year or so will look like. If you're a multifamily investor, active, passive, you're someone in the industry, fortunately for you, you are in the right spot here at the Great Capital YouTube channel. On this episode of the Great Report, we're going to get into all of the most important research reports, new data points circling around the multifamily industry, macroeconomics, and commercial real estate. I'm joined again by producer and director of communications and marketing here at Great Capital, Dr. Matt Bosnagel. Stick around, this is going to be a great episode. Let's get into it. All right, welcome back to the Great Report. Matt, a great slate of articles today. Just before we get into this first piece from CoreLogic, looking at some U.S. home price growth rates and kind of slowing down a little bit. We were just talking about the jobs report that's going to be released this week. Some other just macroeconomic factors that may push the sales of the economy one way or the other. Everyone is on the back of the Federal Reserve lowering interest rates and talking about a slowing down, kind of where that where that nominal kind of rate of growth, that neutral rate is. And so what we were just getting ready to say a couple comments. Let's just record.
My sense is whatever magic of lowering rates has to revive the economy, that hasn't worked yet. It's not instantaneous. Because one of the things that I heard was job openings were up, but though that number is always a little fuzzy and could have some wiggle room.
Well, it's been revised down so many times.
Yeah, it's been revised down so many times. I have very little confidence that it's going to be that it's going to kind of stay up. And also digging into the numbers, I guess the quits and new hires, or there were other numbers within the job openings themselves that actually went down. So there's an open question on how much of these job openings are real and how much are actually representative of better employment.
Well, we got the longshoremen that are going on strike now as well. And so I think, again, a lot of volatility. I mean, we've got the election coming up. And it's signs of a slowing economy, which has been the goal for really the last year and a half. And so I think it's hard for us to determine, again, is good news bad news or is good news good news? And good news has been bad news in the inverse for quite some time. So we know it.
I'm still not. Yeah, I'm just still not convinced that there could be some kind of recession in the offing. Yeah. And so last night I was going to show. The
ingredients are all laid out.
I didn't have time to get to my kids this morning, but I wanted to do some technical analysis. I wanted to print out the employment numbers, just the squiggly line of for employment. And then I wanted to show the kids okay, how would this line go? Because the pattern, if you're looking at the unemployment rate, it looks like it's going to go up. Because everything, if you're following the pattern,
the trend,
the trend just goes up. Now, I think that there's a bunch of different stuff, not the least of which is the huge volatility of the pandemic that we're still kind of bouncing. We're still in the ripple effects of that. So that's what I'm hoping that is the case, that we're in some kind of new thing. But if we're going by the pattern, it just seems so scary.
Yeah, I do think that we are still in the wake of the pandemic. And so I think from the technical side, it can be really tricky to really kind of determine one way or the other kind of where we're at.
Yeah.
All right, let's shift to real estate, Matt. According to CoreLogic, U.S. home price growth reaches its lowest level in a year this August. Bring us in. What do we need to know? This is surprising, not shocking, just because prices have shockingly continued to rise. So not.
And you're going to hear, and especially in another report that we're going to talk about in just a second, you'll hear a lot of talk about, home prices are reaching their record. Well, home price growth isn't exactly. And I do feel a little bit chastened after talking up the price growth in the single family home sector and how it's such a solid indicator of housing demand, which it still is. I wanted to cover this softening as a reminder that home prices are in a world of like limitless growth. They're not. There's limits there.
Well, I think that's the point, and I think the article almost makes it seem like prices are declining, but we're really just talking about the rate of growth.
Yeah,
and prices are still going up, albeit at a slower pace. So the softening, the way
it's the same kind of subdued uncertainty in the economy is present in the single family home market, but it's still growing, and it's interesting to look at. Well, I kind of look at the prices over time to kind of place this current home price data into context, because it's not as if the current home price growth is lower than normal. It's about at like where they kind of typically fall. And again, the most important factor here is the pandemic. Just like in the economy in general, we're still in this ripple effect because yearly home price growth peaked in March 2022 at 20.79%. Then that growth fell month over month until May 2023, when it bottomed out at negative 2.8 yearly growth for just 1 month. And then it moved into the positive territory, growing to 6.5% in March of this year, and it has dipped down since then. It's around like 5 or 4%, depending on if you want to use these CoreLogic numbers or like the official Case-Shiller numbers. And the quote from CoreLogic then for this month is that home price growth moved up to nearly 4% year over year in August, though gains are projected to fall to less than 1% year over year by next spring. So they're expecting a further slowdown for CoreLogic is. This data, it's not the same as the Case-Shiller, which is actually linked to CoreLogic. Like the full name of it is the S&P CoreLogic Case-Shiller U.S. National Home Price Index. We get a little more recent data from CoreLogic here, but again, you look at this chart from CoreLogic, from Case-Shiller in total, and you can see how much home prices have grown over the years. The previous high point for home price growth was 14.5% in September 2005. But looking at March 2022, man, 20.79%. That was that's insane. I'm sorry. Yeah. 2013 was the kind of previous peak, but number two
before
peak.
that. Yeah. You're
It's just interesting that the only other time that it was negative, other than that little blip in May 2023, was during the housing crisis, when naturally it was. But every other time, home prices have been growing. So that's what really annoys me a little bit when everyone says, "Oh, it's record prices, record prices." Well, generally, except for the home crisis, the Great Financial Crisis, prices are always going to be record prices because they're always just going to be growing.
People, forget about that. Sometimes that things tend to grow.
So so the other thing that they noted in the Marcus and Millichap report was that new home prices are actually up. So the home prices in general may be down, or they may be kind of subdued in terms of growth, but new home sales are picking up. That kind of makes sense, right? Because no one wants to sell their house and get a new rate that's higher and pay more. They remember 2.5 years ago, man, it doesn't seem like that long ago, but in a way it's almost unimaginable to imagine that rates could be that low again. People aren't willing to give that up. And so that's making new home prices a little bit stronger, a lot stronger than existing home sales. And the quote here, I'll quote from Marcus and Millichap here. They say that mortgage rate plunge fuels to stoke buyer demand. Existing home sales decreased by 3.3% year over year in August 2024 to an 8-month low. That pullback transpired in the midst of substantial downward movement in the 30-year fixed-rate mortgage. The gauge plummeted by 60 basis points year over year to 6.5% and slackened by an additional 40 basis points through mid-September. Rates are going down. People still aren't buying. So it must be we've reached this wall or the ceiling.
But it also makes, rates are down. So the Federal Reserve, lower the Fed funds rate. But, most homes are not being acquired with mortgages that are directly correlated to the Fed funds rate. 30-year fixed mortgages, they're typically looking at the 10-year treasury.
Okay.
Just like if we're going to go out and buy an apartment building, I can buy it with a floating rate loan. I can buy it with a bridge loan or a agency floating rate loan, or a lot of commercial mortgages are floating rate.
Yeah.
But like if you go, but you can, a lot of times we'll go with a Fannie Mae or Freddie Mac fixed rate loan, which that's based on the 10-year treasury index plus a spread.
Okay.
Same thing with single family homes. They're typically based on the 10-year treasury plus a spread as well. In the 10-year treasury, those rate declines were priced in prior to
That's what I was
the
thinking.
Fed funds rate decrease. We were at kind of mid 4% range, and then we went down to as low as 3.69 or so.
Yeah.
Right before the Fed lowered the rates. I think we're hovering kind of yesterday. We were 3.79 ish. Plus or minus.
Yeah.
So a lot of that had already been priced in, and so that had come down, but it had been like that for several weeks or almost a month.
Yeah.
But if you also think about it, it's a marginal improvement. But consumers, it's going to take them a while mentally.
Yep.
To decide. All right, let's go. And also, rates. The idea that rates are lowered one day and then someone's closing on a transaction on a piece of real estate.
Yeah.
It's just so unlikely. I mean, we've talked about how in commercial real estate apartments, it can take 90 days, but by the time you look at the property to actually closing on it, even longer. More drawn out process. But even a single family home, I mean, you're touring a property, you're making an offer. I mean, 30 days is pretty quick. 60 days is much more reasonable to actually get to to the closing table.
It's interesting. So I've got a chart here that I made myself. I took CoStar data for rent growth and single family home price growth. So this is year over year growth for both of these. And
where is it? Oh,
it's and you can see, first of all, I wanted to make the point that, of course, single family home prices have grown at such a higher rate than rents. So the dark blue line here, it shows the single family home price growth. The peaks are higher, the valleys are higher. I think that and it's, we're not talking about buying and selling apartments, but rent growth is still a little bit flatter in general than single family homes. It's a little more reactive.
Yeah.
It's interesting to see that spike downward in post pandemic or not post pandemic, well, yeah, it was post-pandemic. In 2023, the spike downward of
the decline,
single-family home prices.
Yeah.
Which
kind of correlated with, obviously, inflation slowing down.
Yeah.
And, I mean, we were going through, negative rent growth, and the economy was really kind of fearing a recession at that point.
Yeah.
I think what it was, most economists had a 100% chance of inflation or something at that point.
Yeah.
So
it's capable of these sharp turns, but in general, when we're talking about rents, that's a little bit flatter. But it's important to remember how much prices grew.
One question, we're talking about interest rates. The other thing that, comes to mind, this is also related to rents that we've seen, is that, seasonality factors, typically the home buying, renting apartments, moving in general slows down just prior to kind of school starting. And what I've noticed is that, where in previous cycles, sometimes we would see a continued surge through August.
Yeah.
I've also seen school starting earlier, but in general this year, we saw, rents really not grow as strongly through July. Typically, we see kind of a big push through July, but the peak was closer to, May and June, and then July was a little bit lackluster, kind of disappointing. August is typically things are kind of starting to slow down. We're seeing the same thing in single-family homes, so it almost seems like more of a seasonality factor that's a little bit exaggerated a little bit.
Yeah. This is something that I've seen reported from other people. I think it was Carl Whitaker was saying something similar about how the seasonality of 2023 looks a lot like this year, 2024. How this is a lot, and 2023 was subdued, and so this is going to be equally subdued. So there's not we got to be realistic. And things are taking a little bit longer, but I don't think that I think there is going to be an out of the woods. We're not out of it yet.
Yeah,
there's some hope. There's people projecting, further price growth in the future.
Yeah.
So
I think there's obviously some supply we have to work through.
Yeah.
Got to lease up some apartments, but that's going surprisingly pretty well right now.
Yeah, and that was another thing I wanted to cover. I wanted to get all, because recently this week, or the past week or so, there was released a lot of the new residential construction numbers. So, so multifamily starts, multifamily permits, and the completions are high, but permits are not. And so the amount of multifamily under construction right now is going down very quickly, and it's not looking to pick up according to how much there have been permitting and stuff. So I think that's an interesting development. It's something that we've seen definitely coming. We know exactly why it is. It's because of the interest rates and because of the existing supply. But it's a relief for people, for maybe investors that are in an oversupplied market, that it's not going to keep getting oversupplied. Although I have a when we talk about this migration report, I'll have a nice bit of relief for anyone that thinks that they bought and overbought, because man, there are some places that are growing gangbusters. And it's all the oversupplied places. People are moving there. So it's not like no one's an idiot here. They just got to wait a couple of years.
No. Again, a lot of good reasons to build and invest in those markets. There was definitely a lot of concentration. Everybody kind of had the same right idea, which you can make the right idea wrong, maybe for some. But it depends on your strategy and your vision and your ability to persevere and wait. So if you need something to happen in a year, good luck. But if you're okay waiting a couple of years, maybe you'll be all right. Okay, this piece from Goldman Sachs, kind of on a similar topic, but really taking looking into the future a little bit. What you were just talking about, Matt. U.S. house prices are forecasted to rise more than 4% next year. Well, again, as you said earlier, there's just kind of no stop to the increase in pricing. That's not going to make housing more affordable in the United States. And I'd imagine, again, just as you said, if we're seeing a decline of single-family and multifamily supply, I don't imagine rent growth is going to take too big of a dip in this type of scenario. But what's Goldman Sachs and the deep pockets?
I really like...
What a bad picture.
There's like a conversational tone to this article. Is really interesting to me, because it's like, this is Goldman Sachs, but they're clearly like, they could be nerdy if they want, but they're really trying to make this very conversational. I kind of like it. The comment. So this is the quote here that I really like, this passage. It says, "We're not seeing higher permanent layoffs, at least not yet. The reason why..." Now this is like about 3 weeks old. So you can talk about the timeliness, but I still think it's very valid. And all right, so they say the reason we think right now that bad news is good news is that rates are falling because of concerns around employment, and we don't think those concerns will really affect the housing market without income loss. All you're really seeing is that the cost of buying, of taking on a mortgage, is coming down. To that end, we've already seen substantial improvement in funding costs. Just to frame this, the peak in the cycle saw mortgage rates at about 7.8% in October 2023. Mortgage rates have since fallen all the way back down to below 6.5%. We believe we're well past the peak in mortgage rates, and we think it's going to be a slow but steady grind lower over the coming years. So, not a whole lot of $10 words, really kind of simple terms, simple. And like, I think that they make a really good case. Like, it's not an emergency right now. It's gonna be a slow and steady grind. You can't expect things instantaneously, but there's promising signs. And the most material thing is the fact that we're trending lower. Yes, I know that 10 years saw this coming a long time in advance, but I wonder, are we going to see a pickup if there are any subsequent rate cuts, maybe in November? Like, has the market price
people getting? I mean, partially. I think partially. Yeah. I think there's a little bit of like, all right, let's just see what this first one did.
Yeah.
But all of a sudden, if we 50, it's a decent move. But does it change everything? No. But all of a sudden, we've gotten 100 within a couple months. That all of a sudden does start becoming real. And then if you start looking at, okay, are we going to see a couple, 25 basis? Because most likely what I've been hearing is, maybe we get another 50, maybe it's 25, but if we get another 50, so they do a lot of the work up front and then just very gradual 25 basis points here and there. But also, if we get a couple hot inflation reports or unemployment does start running hotter for any reason, we could see them kind of just staying put for a while. Also. But I don't. My gut is we're not going to see that. I think it's going to be continuing to normalize, and we kind of have the all clear.
Yeah,
we shall see.
Yeah, that's a good point. I think that there's no reason also when we're talking about housing demand to think that home prices would really fall off a cliff outside of external factors like employment or anything like that. The housing demand's there, and we're seeing it. Whether it's household growth or any of these other factors.
It was interesting, Matt, watching the vice presidential debate last night, and they talked about housing, not a ton, but more than your average debate, I would say, or political conversation. We've covered it a handful of times on the Gray Report of just how housing is taking a much more central issue in politics on the national level, but also on the local level as well. J.D. Vance mentioned something related. They were talking about mass deportations, moving immigrants out or restarting deportations, however you want to frame it. And one of the reasons that J.D. Vance was stating for why they needed to do that, or really the benefit, was that illegal immigration's putting pressure on housing supply, and the cause for housing prices the reason why housing prices have stayed elevated is because of illegal immigration, which I thought was interesting, because we talked about it. It certainly has increased rent growth in those those southern states.
More people, you're going to have more demand for
more
housing.
people, you're going to have more demand for housing. But it was just an interesting. I hadn't seen it framed in that, I guess, context before. Having to control housing costs by focusing on your deportation policy.
Yeah. Well, at the very least, it's an acknowledgement of housing as an issue that motivates and really top of mind for voters, I think, right now. I think also that, if you're thinking about immigration is connected to a whole lot of things. You could, they talk. J.D. Vance would probably talk about immigration, crime, housing,
welfare, taxes.
There's a number of things, and if you're in that frame of mind, then sure, you can talk about that. But there's also other relevant aspects of housing that we talk about every single week that are not directly related to immigration and are still driving housing.
And
prices.
it's not just one thing. You just talked about real pages and driving rent growth.
I also want to talk about too, the location of some of these places. Like we talked about how they had all these plans for putting housing on federal lands, and Tim Walz did note federal lands aren't exactly right where you need them. And this is something that I remember saying early on in the Gray Report. You can't exactly pick up a house and move it to where you want. Housing's not necessarily a commodity. It's something that's very place oriented. So just to say, we'll just build in the middle of
in the desert,
middle of Utah, that's not going to really work. So I think that both points made on both sides very valid. I think that both would agree probably that that regulation is a big factor in zoning and things like that. And so I'll admit I didn't watch 100%, but I watched most of it. I watched most of the debate. And one thing I didn't hear in the discussion of housing was any note about supply. I think there was maybe a note on
they asked about, they're like, you say you need 3 million homes, how are you going to, they basically were like, how are you building those homes? No one really had a great answer other than some federal lands or just broad strokes. But not now, moving off from immigration, talking about migration. There's a difference. Colliers, national migration trends in the United States. U.S. Research Report.
78 pages. We're just going to go over the very beginning. It's because they have...
It's comprehensive. But you know what, Matt? For folks that do want to take a deeper dive, the Gray Report newsletter is a great way to do that. Obviously, we've got all these in the show notes you can click over, but if you sign up at graycapitalllc.com/newsletter, Matt's going to send you an email twice a week on Thursdays, every morning at 8:30. It's packed full of all the latest research reports that come out and some little bit of commentary. So you'll get stuff like this sent straight to your email. So if you go to graycapitalllc.com/newsletter, or there's a link right on the our homepage. But anyway, Matt, bring us in.
So the bulk of it is actually a market by market information on migration, inward, outward, and they do some kind of calculation on how much money is flowing in and out. I didn't read into the methodology there, but I did want to focus on these regional implications, and this is a fresh topic. I think we've covered a lot of things about housing. I'd love to return to these migration stories. There's one by I think United Van Lines does some, and U-Haul. They have these figures of what states are they moving in and out of, and so here's the basic story. And I'll just start here with a quote from Colliers. Next year's data is likely to show that downtown areas have partially recovered from the impact of the pandemic. For now, studying migration during this period reveals regional population preferences and a possible roadmap for companies trying to locate in places that attract the most people. Guess where it is? it's in the South. I didn't want to bury the lead that much, but this is going to be news for anyone hoping that there's been a surge of interest in the Midwest. Maybe lower housing prices will continue to be a draw for people, but in general, migration tends to flow away from the Midwest states. It doesn't help that the cities with the most positive migration are those on the borders of the region, the central region as described by Colliers here. But the Midwest isn't alone. The West has negative migration at 292,000 compared to the the West has negative migration at 213 or something. I miswrote this. Well, anyways, the rest...
I'm right there. Here.
Yeah, 227,000 compared to the 292,000 of the Midwest. The Northeast has negative migration to the tune of negative 714,000. And where are they moving to? For goodness sakes, they're moving to the Sun Belt. It's all to the Sun Belt. The South is the only region with positive growth numbers, 1.275 million. This is why investors really feel so great about buying apartments in Austin, even though apartment supply has gone through the roof and rent growth has been firmly negative in Austin. People are moving there, and really, boy howdy, are they moving there, to use a Texas howdy language. Austin has the highest in-migration of the cities listed here if you go by percentage of population. So,
everybody's moving from... basically, as we all know, LA, San Diego, San Francisco, and Seattle to Dallas, Austin, and Houston, San Antonio, and Nashville.
Yeah. And by raw numbers, Dallas-Fort Worth is getting the most. But again, if you're going by percentage of population, they're all pouring into Austin, Texas. Miami is a big draw too. It's just a lot of these people are pouring into that region. This is the place where they built all the apartments. Miami.
I think this is an interesting chart, Matt. Some of the biggest winners and losers of the COVID-19 era, with the biggest loser on this
population.
Chart, of population. San Francisco being the biggest loser at negative 4.6%. Percent of 2020 population change, with Tampa being the biggest winner at 3.5% growth, followed for the winners, followed by Austin, then San Antonio, Phoenix, Vegas, Dallas, Riverside, Charlotte, Orlando, and Houston. Not a lot of shockers, and then again the losers, worst to not as bad: San Fran, New York, LA, Boston, Chicago, Washington D.C., San Diego, Seattle, Miami, and Detroit. Miami is the one that's surprising. On that list. Surprising. Where's are people like moving from Miami to Fort Lauderdale, or Tampa? They're going up to Tampa.
Yeah, I didn't notice that.
That's interesting.
Yeah, that is really interesting. And again, it proves the thesis of people that are confident in these Sunbelt markets. The issue is that we're not going to see is that it's far easier to overbuild of apartments than it is to wait for migration. It's like it's a lot easier to get the apartments in there than it is to get the people in there that will fill those apartments. So what they'll have to do is wait it out. And we've seen, subdued rent growth. It's not horribly negative.
Yep.
But there is, there's no reason why any of these developers, maybe that have just built an apartment in Tampa, for instance, there's no reason why for them to freak out. So that's that. And also equivalently, there's no reason maybe for people in Indianapolis or Columbus or Detroit to really freak out about like outward migration. We're talking about shifts of at max 5% change in migration. Yeah. So this is not like a 5% change in the population. We're talking about the growth or lack of growth or negative growth of migration. So it's a little bit fuzzy with the numbers if you're just looking at that base, though. We're not talking about millions of people. We're all these entire regions. We're talking about hundreds of thousands. So it's not. Yeah, we're not talking about waves. It's just it's a relative thing, and it's still, I think, really interesting. People are still going to the Sun Belt. Hey, climate change has not made it too hot for them. This Hurricane Helene, I think people are still going to keep moving into Florida, and they're still going to be interested in living there. That's not going to change really quickly either.
It's interesting. Just I'm curious, understanding what is this? The AGI, Matt, aggregate gross income. These huge like negative numbers in 2021 through 2022. They bring those numbers down. I'm just curious when it was relatively positive in some of these markets. But we'll dig in. Get back to everybody.
Yeah.
Next one. All right. Next, we have a piece from Moody's Analytics looking at the Q3 2024 preliminary trends. And where are we going? And where have we been in this third quarter?
Where have we been?
Just ended a couple days ago. And then, so again, what does the end of the year look like? And maybe a couple hints for 2025.
Really great overview. Still great stuff at Moody's. This is, to borrow a turn of phrase from the entertainment industry, a Thomas LaSalvia joint. And of course, it's great from the great LaSalvia School of Moody's Analytics research. Nice summation of these different CRE sectors. Give us a good sense of how everything's doing without, kind of unnecessary details, but without sacrificing the important ones. Multifamily stable. Office is still markedly weakened by widespread work from home policies. Retail's a mixed bag, but has vacancy trending lower. And the industrial real estate market is currently navigating an adjustment phase following impressive inventory expansion and surging demand in recent times, while construction trends have slowed. I kind of skimmed down to the concluding remarks. Now, there's all of this is played out with graphs and more information, especially about multifamily and kind of the stability of the multifamily. That was what I was looking for. But in conclusion, they are saying the 50 basis point rate cut from September's FOMC meeting was a significant move towards economic recovery. It was more aggressive than anticipated, but essential for consumer financing, CRE lending, future real estate investments. Commercial mortgage debt outstanding grew at a modest pace in the second quarter due to new origination, fewer payoffs. So there are, mortgage debt's not growing because people aren't getting loans, but lower long-term interest rates should get things moving again. And full employment, steady wage growth, lower inflation, that should also foster healthy household formation for the kind of multifamily market. And also for the retail and industrial sections, they say that multifamily, retail, and industrial sectors will continue to capture opportunities arising from improved affordability and ongoing lifestyle changes. I think that what's key here is they say that we're not at economic recovery, we're moving towards economic recovery. So, we'll get more sales activity and price discovery long term on the, as we proceed on this path, which assumes that inflation doesn't creep up, employment doesn't stick down, and household growth continues, but we're not there yet.
Does sometimes, Matt, the perceived confidence of economic recovery or economic positivity sometimes concern you?
Yes, it does. Because I look at this chart that I was going to show to my kids, and I was like, the chart seems like things are going to go bad, but
no, it's fine. The experts are saying it's fine. And because I say that because all the experts last year and a half said, a recession was certain and imminent. And so what can be so certain and clear and obvious doesn't always come to fruit, it seems.
And that, what no one was really predicting? A full year. And I mean, I guess if you're counting 2023 too, like 2 full years of just like waves up and down. Hey, everyone can predict like super great growth. Things are going to be better again.
10 years.
It's easy to predict, horrible doom and gloom, but it's really hard to predict this point where like we're not going to know what's going on for like 2 full years. We're not going to have a clear trajectory for 2 full years. Things are going to be reduced.
Talk about, since 2020.
Show
me the point in time where it's like, oh, okay, the trajectory is clear.
2021 and 2022, things were. Man, it was so sunny.
but in a way that was like, this isn't sustainable.
Yeah, that was like ecstatic,
inflation was at 10% and interest rates were 0. And we were like, wait a second, something's wrong here. And rent growth was 20 to 30%. Like this can't go on forever. But there were, if you were selling a deal right then.
And my only thought here is that we are not we're still. I think that we had the first bounce of whatever happened in that 2021, 2022, kind of this like the euphoria of the economy and low rates and everything. And we had a reaction that was kind of in 2023 and maybe a little bit of this year. Maybe we'll crawl out of it, but I don't know where the heck we are. Because you can point to specific reasons. And that's what I think Moody's is doing right here. And all these economists are pointing to real causes and effects. So it's not illogical what they're saying. It's just illogical what has happened in the past. So
That's true.
So it's hard to plot from the future because everything crazy has been happening.
Yeah. Well, that's what we're trying to do over here on the Gray Report is figure it out or do our best.
I think we got it nailed down.
Yeah, at least, again, I think that what we try to do is bring the best pieces of information, data, research.
Yep.
And then we can make some of our own decisions. And not always going to be right. Sometimes we're going to be wrong. But at least I think if we can paint a complete picture, we'll be armed with some really good information. And some folks that are watching and listening can also make some really good.
Don't bet against housing demand.
Not right now. So make sure you're subscribed to the Great Capital YouTube channel. You can leave a comment below this video. Let us know what you think. Right, wrong, agree, disagree, or any thoughts for future episodes, any topics you'd like to see covered. And don't forget, we got the newsletter on the website, greatcapitalllc.com. Highly recommend. It's the best commercial real estate newsletter with a focus on multifamily that gets delivered once a week for the full version, and then a smaller digest on Sunday. And, if you're interested in learning more about what we do here at Great Capital, buying, managing apartment buildings in the Midwest, if you're a credit investor, go on the website, greatcapitalllc.com. Get in touch with us, schedule a meeting. We'd love to learn about if it's a good fit for us to work together or not. But thanks for watching this episode. Catch you on next week's episode of The Gray Report. Thank you.